Hey, everybody, welcome to another episode of the Under the Hood podcast. This is Tim Douglas, and we have Matt Cohen on the show today, where we'll be talking about why the 60/40 isn't dead, the definition of alternative investments, and the power of clear, actionable communication. Matt, does that sound good?
That sounds great. Let's get into it.
Thanks for coming on the show. And we like to jump right in, hearing a little bit more about just who you are. So if you could jump into your story, your kind of journey into the financial space, that'd be great.
Yeah, sure. So I've been in the wealth management industry for 20 years, but I ended up here, I'd say, in my current wealth advisor role, in a pretty unusual path. I actually started off on the consulting side of industry, helping independent RIAs leverage a technology and a research platform to improve their business. And I did this for about 11 years and got a great education in how high functioning advisory firms are run, how to perform manager search and due diligence. This includes alternative investments, and really translating all this back into something a client can understand. In hindsight, it was only a matter of time before I shifted to the advisory side of the business I was consulting into. I mean, that's kind of the age-old process, right? You start consulting, and then you work for the industry that you consult into. I made that shift and joined West Financial back in 2015. And I started out actually on the portfolio management side of things, which had much more of a focus on investing, or I should say investments. And over time, I realized that my passion really included more on the estate and tax strategy side and helping retirees convert a lifetime of savings into an income stream that they can depend on. And that's what I'm doing today, and I love it.
Yeah. Yeah. No, absolutely. That's awesome. And so you started first 11 years or so in the industry. You were consulting independent RIAs. You made the jump in 2015. And do you specifically help retirees, or is your client base kind of across the board?
I mean, it's definitely across the board. I would say the predominance of my book are, and I work with about 110 families here at West Financial, and I would say that the majority are either retired or going to retire in the next, call it 5-10 years. I do work with a number of younger clients or clients that are still accumulating assets. Those tend to be either the children or grandchildren of the current clients.
Mm, I gotcha. I gotcha. Makes a lot
or,
of
or
sense.
small business owners. Yeah,
And so where do you go to stay kind of up to date with the latest market trends and financial strategies so that you can keep your clients up to date and make sure that they're on top of their portfolio construction?
sure. Well, you're not going to love this answer considering the format that we're communicating on, but I'm an avid reader, not so much a consumer of podcasts or videos or things like that. And a lot of what I read, honestly, it's mainstream. So The Economist, the Wall Street Journal. I mean, that really gives you a great coverage of macro trends happening in the economy and the world. We get access to industry publications from like the FactSets and the Bloombergs of the world, materials from investment managers I like and trust. That kind of helps me get into the weeds on kind of the micro side of things. So, investment strategies, opportunities across asset classes, and so forth. I am from the DC area, so I both work here and I'm from here. So I'm definitely a political junkie, and so the editorial pages of, again, the Journal, the Times, the Washington Post. I mean, that really provides me with tax policy and other potential market moving political news and I try to have it cut across the political spectrum. Most importantly, though, whether it be like political views that I may not agree with or investment strategies that I might have a bias against, I do try to seek out those opposing viewpoints to see if my mind can be changed about a subject. I think that's really important. Sometimes after you read a thought-provoking article, I might change my opinion on a subject matter. Other times, it might just reinforce my previously held belief, but it made me at least challenge where I was coming from. So I think that's always important, no matter how you're accessing, media.
That's interesting. I was about to ask, when you go seek out those opposing viewpoints, do you ever actually change your mind? And it sounds like you do. Would you say that's a thing that happens often, or by and large, you're
I
kind of
know I would say that's more on the. I mean, that's definitely the minority of times. But at least if you come back with your same viewpoint affirmed, you've had to justify that to yourself.
Mm.
And so you've had to make the case again to yourself, go through the opposing viewpoints and say, okay, I disagree with this, that, and the other, and it makes you, stronger, better, frankly, as an advisor. And it also, the clients are reading the same stuff. So partly why I read a lot of mainstream press is because that's what clients are reading. So oftentimes clients will say, hey, I read this, interesting article in the journal, or I saw this in the Economist, or I saw this someplace, and either I've read it or I will read it after that, and I can at least have an intelligent conversation about the subject.
Yeah, yeah, absolutely. So let's jump to the current market. Talk to us a bit about what factors are most important to pay attention to in today's market, and then your high level strategy to address those factors when you're talking to your 110 families in your client
Yeah,
base.
it's funny, like, you talk to me now versus 2022, I think we'd be having a different conversation. But, I mean, this is I mean, in some ways, this is a really hard market to stay invested in, right? So you've got, the Federal Reserve probably at the end of its rate hike cycle. Historically, that tends to coincide with a slowing economy. You've got this massive rally in AI aligned stocks and pretty much any other speculative part of the market, like Bitcoin. Those are all sort of rallying and back at all time highs. And then you flip on the news, and the only way for pundits to sound smarter than everybody else is to take the other side of the trend. And so you've got all these bearish talking points out there and reasons for the market to crash. And so it's not unreasonable for an investor to come to the conclusion to say, you know what, hey, let's sell my equities down. They're back to the 21 highs. I can reinvest into a 5% money market and just not worry about it. I do try to look at things a little bit differently. I do start with the notion that nobody knows the future, and anybody saying that they do is offering nothing more than an opinion. And it's a fun parlor game, but it's nothing more than that. And so what we do know and what we do focus on are objective data. So jobless claims, you know what they are, what the yield curve is today, and what I can get for taking risk out 1, 3, 5, 10 years. What the equity valuations are. I mean, these are all objective, measurable data points, and then you just got to make the best decisions with you can with the data at hand.
Yeah. Yeah, no, absolutely. And so when you have clients coming to you and they're like, "Hey, let's set on the equities, let's move into the money markets." Are you taking the time to kind of walk them through that set of data? Or are you like, "Okay, let's sell them down before pre-conversation about hard facts, if you will?"
Yeah, I mean, my job, and frankly, I think our industry's job is to keep clients invested, right? So you come to us, we come up with an investment strategy. It's got to work in down markets. It's got to work in positive markets. That doesn't mean that you don't make little tactical shifts here and there, but ultimately, the way that you make money and grow your wealth is by compounding. And the only way you can compound is to stay in the market. And the more decisions you make, it's baseball season now, so I'm use an analogy there. But the more at bats that you have, the more strikeouts you'll probably have too. And so no one's going to be batting 1,000. And if you're constantly trying to move in and out of the market, you just can't be right enough of the time to warrant that kind of activity, in my opinion. And so really, it's making sure clients understand that four out of every 5 years are flat to positive for public equity markets. That's historical fact. I don't know when that fifth year will happen when the market is down, but I'd rather be invested for the 75% chance that this year won't be negative. That's the way that you really got to sort of educate clients for.
Mm, that's a great point. And I noticed there you were talking about when you make that investment plan, it needs to work in down markets, needs to work in up markets. And that is a perfect segue into our next question about risk. When you're looking at
Yep.
risk in today's market, um, kind of what's your strategy to address it in your client portfolios?
Yeah, so I think that the big lesson from 2022, and that's anytime you get a year like 22, you've got to come away with a lesson learned. And to us, the big lesson in that year was you've got to have assets that retain their value no matter what happens with rates, no matter what happens in the economy, no matter what's happening in general. And contrary to the popular narrative, that classic 60/40 portfolio that didn't die in 22 and is not dead today if you've had fixed income structured properly and you had enough cash on hand. And I can kind of delve into that in a bit more detail. But if you think about today and what the opportunities there are today, you know, cash is an asset class again. You know, with the 5% yielding money market, if you expand that 40 part of the 60/40 portfolio and include cash as that safer portion of the allocation, then you've got probably 2/3 of your long run equity returns bottled into an asset with low volatility. I mean, we haven't had that in 15 plus years, where an investor could really dial back the risk of their portfolio, but not take on an incredible amount of opportunity cost by being out of the equity market. So, for investors that don't need or don't want to take a lot of risk, this is a great market environment to sort of dial back some of the equity exposure, lock in rates with investment grade fixed income, and also keep some cash on hand.
Mm, yeah. No, that's interesting. A lot of people talk about the money markets, and then the question I would bring up is, how long do you think that 5% money market is going to be around?
Well, I just told you that no one knows the future, so now you're going to ask me to make a liar out of myself here. But you know, no one knows, but my take on that would be it's not here for a long period of time. I mean, if you've got GDP growth in the 2% range as the trend, it seems, and inflation, depending on your metric, somewhere in the high twos, low threes, as a longer term trend, it seems unreasonable to have Fed funds rate continue to stay in the mid fives. So, you know, who knows what the next move is or how many cuts this year or next year, but it seems more likely than not to me that rates are probably going to trend downward to a degree. And so, you're right. I mean, the implication of your question is how long can you hide out in cash? And, the answer is probably not forever. And so you certainly want to at least hedge a little bit, with some longer dated securities as well. So, everything is, again, you don't know the future. All you can do is prepare for potential possibilities.
I gotcha. And so, in terms of today and the current state of the market today, cash as an asset class and the foreseeable future, that being the next hour or two,
Yep.
um,
Yep.
cash is a good option because you can get, like you said, 2/3 of your expected yield in a very low risk asset. And so, are you having clients? Let's jump to portfolio construction here. Are you having clients put a decent chunk of their assets just in cash, like 20, 30, 40% as a typical rule of thumb? Or kind of how are you looking at that portfolio construction for 2024?
Yeah. Yeah, I mean, certainly not that high, but I would say the way we're using cash is really to accelerate or to sort of lock in potential spend over 12 to 24 months. So if I think back to what we were doing in the 2010s when cash was zero, equities were running hot, we might, if a retiree is taking a draw off a portfolio, we may want to raise 6 months of cash and just keep that on hand, spend that down, and then as that gets down close to zero, then you make a rebalancing decision. Are you going to trim some equities back, or are you going to let some bonds mature? In today's market, why not get a year's worth of cash or 18 months worth of cash flow needs banked today, particularly if you're going to take some gains off the equity markets and pocket that 5% along the way. That's really the way that we always think about cash is a function of cash flow needs, since so many of our clients are taking some kind of draw off their portfolio. And if you're not taking a draw off your portfolio, then again, if you've got 20-30% in cash, to me that might be a little bit too much. You're making a big bet that markets are going to decline, and again, for 4 out of 5 years, that's not the right way to go.
Yeah. Yeah, no, that makes a lot of sense. And I'm also curious with it being an election year. I know I actually don't know the stats, but what I hear is that in election years, obviously the current president does not like the market to be down because every time the market is down and it's an election year, doesn't the incumbent president lose or something like that? Like, isn't that the stat around it?
Yeah, I mean the sort of inside the beltway on that would be you sort of get all, and administration tends to get its bad news out year one, right? It's because they've got 4 years to go until they have another election. So you fast forward to an election year, year four of an administration, they want to get all the good news in as much as they can. So that's when you see, loan forgiveness, or you see, all these different gimmicks. They're going to try to put pressure on the Federal Reserve to, lower rates to try to juice things up. So, those are all the sort of the political games that get played. I'll be honest. I mean, that's probably the most often asked question that we'll get this year, is just how do politics impact portfolios? My take is it tends to impact volatility to a large degree. It really doesn't impact returns. If you think of corporations, they're donating to both political parties. They're not going to put themselves in a position where their business model is in peril if one party is elected versus the other. I mean, that's just a bad business process, and that company wouldn't stay solvent for very long. And so, companies tend to do well under a wide range of administrations. I mean, look at just the past 2 or 3 administrations. You had 8 years under Obama, 4 years under Trump. Now we've got 4 years under Biden. That's some real political whipsaw if you think of those different administrations' views on tax policy, on regulatory regime. And the markets have been pretty resilient throughout all of those very disparate administrations. So, markets can handle a lot of political noise.
I gotcha. I gotcha. So it affects volatility, but does not affect overall returns because companies are smart. They know how to interact with the
That's right.
public side of the market, if you will. And I'm
Yep.
curious. So you have pundits who are like, okay, there's all this bullish stuff going on, with Bitcoin, with the markets, with everything that's going on. And then you have the pundits saying, well, the opposite is going to happen. And this is why, just so they can look smart. And we have clients hearing these competing two factors. How do you help them through the mental side of that regarding their portfolio?
It's so tough. I mean, you just have to keep going back to basics. We're in this allocation for a reason. Here's what it's done for you since we started working together. You look back at previous dips. Clients that were around back in the great financial crisis. You say, remember how much that was painful, how painful that was to you, and then you show it on a chart. At least the way their portfolio values went down, but then recovered. You do the same thing in 2022. You do the same thing at the end of 2018 when we had that sell off then, and you just remind them that markets correct, markets crash, but they recover. And the one big mistake, in my opinion, that you can make during a prolonged downturn like we had for 2022 and for the first part of 2023 is to be in a position to be a forced seller during uh, for with low prices. And so, again, it's going back to that first comment I made. Do you have enough cash on hand? Have you spent down your cash? Should we raise another 6 months, 12 months? Like, maybe we don't, bring it down a ton on the equity side, but let's do some trims and let's raise some cash and kind of lock in your cash flow for the next year. To me, that's a really great move if we do have some turbulence as we get towards the back end of this year or the first part of 25.
Yeah, yeah, it makes a lot of sense. It's the mental game, the emotional game when it comes to money. Grounding
Oh
that
yeah.
in the practicals is about the
Yep.
only tactical thing you can do there.
Yep, absolutely, absolutely.
Yeah, yeah, and I guess tangential point here when you have clients coming on, are you trying to align that kind of emotional, kind of mental game of money with also your perspective? Because I'm sure some are like really risk oriented, others are no risk. And to an extent, you need to be able to serve both of those. But at some points, is there just a misalignment where it's like, hey, you're probably better off with another advisor? Talk to us about that process a little bit.
I don't think so because well, at least that's not the way I practice. I mean, I've got clients that are all in bonds, all in fixed income. That's their comfort level. We have intellectual debates about that with those clients, but ultimately that's what their stomach of volatility is. And I've got on the other end of the spectrum clients that are all in the equity markets at varying ages, at varying stages of life. To me, the most important thing for an advisor to remember is that it's not my money, it's the client's money. And so ultimately you try to guide them, you try to educate, but their values, their opinions, I mean, that's what matters. You try to bring as much objective data to the conversation as you can. what are your spending needs? Because that's kind of the easiest thing to solve for. How safe or how aggressive do we need to achieve that? And that's a great place to start, because then you're not starting at a point of feeling or what does my gut say when the market drops 20%, but you're coming from a place of objective fact by saying, okay, I need $100,000 used off this portfolio. Let's save up 5 or 6 years into a nice secure bond ladder, and let everything else go into the equity markets. And so for a smaller portfolio, that might look like a more conservative allocation. For a large portfolio, that might be less conservative, just because they might only need $100,000 a year off it. A client that has a huge spending need, you got to have that frank conversation that they may have more risk being too conservative, and they won't be able to meet their goals, and you just have to lay that out and see what they feel like. The mistake is if you try to put your own values onto a portfolio in terms of risk tolerance, then you get a year like 2022 where someone was taking too much risk and they're frantically calling you asking to sell down when it's not the best time to do that, and you don't have enough assets to cover their spending needs, and there's been a mismatch. That's a failure on the advisor, in my opinion. And so that's really what you're trying to avoid.
Yeah. Yeah, no, absolutely. That makes a lot of sense. I do want to kind of take a deep dive into portfolio construction, just ask the
Sure.
one question on it, then we'll jump to alts. So, when a portfolio geared towards asset accumulation versus income in this environment, how are you differentiating those two right now?
Yeah, I mean, so asset accumulation. Let's just call those younger investors, right?
Yeah. Yeah.
I believe having a high allocation to public equity markets, it's still the most fantastic wealth creation tool that's ever been invented. And I work with a lot of the children and grandchildren of clients. Almost all of them in my book are invested in diversified equity portfolios. There's a catch though, and this is what's so important. Compounding returns over years, over decades, that only works when you can ride through those down markets. And so if you've got a year like 2022 to keep bringing that back up, and that young person gets laid off, do they have that emergency savings account with 6 months of expenses saved up? What I try to do with younger clients who are in that accumulation phase is to ensure that they do have those near-term expenses covered outside of their brokerage account. And that could include saving for a down payment, a big trip, not just living expenses there. And if you've got that covered, then you've created a capacity for risk taking with their brokerage assets, and you really can be much more aggressive and go for higher potential returns. And it's the same thing with their retirement portfolios. If you're a younger worker and you've got decades to retirement, these are in accounts that you're not going to touch for 20 plus, 30 plus years. Go with a diversified equity portfolio and just don't look at it all that often, right? And I'll say, call me when you're 10 years or so from retirement, and then we can talk about some of these risk mitigation tools that we were just speaking to earlier.
Yeah. Yeah. No, absolutely. And so, higher distribution for kind of younger investors into the equities market with a 6 month, maybe longer, maybe a little bit shorter if they have a certain risk tolerance. Um, and then for kind of older investors, is it kind of that
Yeah.
typical 60/40 still, or 40
It
60 other
it
way?
So it really it really depends. So there's that adage of like you take your 100 minus your year, and that's your equity allocation or something like that. That's always been bunked to me. I'm a big proponent in total return retirement income strategy, and I find a lot of retirees are overly focused on yield to the detriment of the growth of that asset base. So a high yield strategy that offers a 10% dividend, but that it sees its net asset value decline by 15%. That's counterproductive to me. Another issue is that same yield that's covering retirement expenses today, is that going to cover those retirement expenses in 5 years and 10 years? Is that income growing over that time? And what happens if there is an illness? What happens if you've got to take care of a family member that you didn't expect to? this is why growing that asset base is so important. You can't just focus on the yield side of the return equation. And so that's why we think about retirement portfolios is, you've got to grow the assets in addition to just getting current income. And to your question about coming up with an allocation, again, I just go back to what's objective. So, let's look at what the cash flow needs are. So if we can bank 4 to 5 years of that annual spending as a baseline for the bond allocation, that's a great place to start. So, take that $100,000 spending need from a portfolio. 500,000 sort of becomes that initial bond target. So in $1 million portfolio, you're talking about a 50-50 allocation. Obviously, a larger portfolio would have more equities, less to bonds on a percent basis. But then you can adjust that based on risk tolerance. If they really are risk adverse, then you might have less in equities. If they're not so risk averse, you can amp it up a little bit. But then, and here's the big lesson from 22, you invest that into an individual bond ladder going out maybe 6 to 8 years. And this way you've got steady maturities year after year that gives the portfolio something I'll call cash flow optionality, which I know sounds really buzzwordy. But in essence, you've got 15 or so percent of the bond allocation that comes due at par every year. And so you can show a client, and we did this in 22. You'll say, hey, listen, you've got $100,000 of maturities coming between now and next April. We've got you covered from a cash flow perspective, no matter what happens with rates, with markets, and with the economy. And we're not going to be a forced seller in the equity market when we don't want to. And then you contrast that to a year like 2024, and instead of using those maturing bonds as cash flow, we can just reinvest them into this really, really nice yield environment that we're in, and instead take some of the gains off the equity side of the portfolio. So, in short, most years you're using the income and the capital appreciation to provide that cash flow, and then when you get those really nasty bear markets, the fourth out of fifth year, if you will, that's where you use the maturing bonds to facilitate client cash flow needs, and that's really been successful for us in the 40 years that we've been in business.
Yeah. Yeah. That makes a lot of sense. And is that by and large why the 60/40 isn't dead? Because you approach that kind of portfolio
Yeah.
construction like that?
Yeah, so if the 40, so if you think about 2022, certainly our individual bonds that were dated, past 2 or 3 years, they got hit on price like everybody else is. But with bonds, you've got this gravitational pull towards par once you get within 6, 9 months of its maturity date. And so it really acts as a source of stability in the portfolio. I know bonds got written up as being horrible investments in 22, and certainly they lost on price for sure. But if it matured, Honda Corporation owes you 100 cents on the dollar.
Yeah.
American Tower, they owe you 100 cents on the dollar, right? So when those things mature, as long as the company is solvent, they're going to pay you back at par, no matter what's going on with the rates.
Yeah. No, for sure. That makes a lot of sense. Makes a lot of sense. And so let's jump to alts now. Talk to us a little bit about how you evaluate alternative investments when you're looking at
Yep.
them in 2024. Is it the manager? Is it the strategy? Is it the niche? Like, run us through your
Yeah,
process.
so let's kind of define alternative investments first, because I do think that word means a lot of things to a lot of people. At a high level, I see alternatives categorized really into three broad buckets. So the first are trading strategies. So that's like, think of managed futures, market neutral strategies, long short equity, things like that. The next are the private markets, like private equity, private credit, and the last would be real estate, either on the equity or the debt side. I'm really quite skeptical of the first category. Those trading strategies, I mean, they were really hot in the 2000s, and they performed well since the great financial crisis. They've been just dismal relative to traditional asset classes. And I know that they get touted for their low correlation to stocks and bonds, but if something is low correlated because it doesn't earn any money for 7 years out of
Yeah.
8, who cares, right? I mean, that's not the kind of correlation I'm looking for there. Private equity, on the other hand, that really can be attractive and additive to portfolios. The issue with private equity is access to quality funds. And so unless an investor is with a top private equity fund, historical data shows that the returns have not been that much better than public markets, and in some cases they've been worse. And so those top quartile funds that you really want to get into on the private equity side, I mean, they're just really tough to get into. They're more geared towards institutions. Now, there's been a trend in this space where you've got what's called a private equity fund of funds, and that sort of gets around the access issue. But there's some drawbacks there, which is you're in essence going to dilute those top performing funds by having exposure to maybe the not so top performing funds. On the private credit side, that has become something that we've been quite interested in lately. So here you have investor funded, it's in essence an investor funded loan book that goes out to smaller companies that historically were getting their financing from the traditional banking sector. And since Dodd-Frank, the banks have really kind of receded from this middle market lending space. And yields today are north of 10%. The loans are usually senior secured. And what I really like about them is they're actually held on the balance sheet of the private credit fund. They're not just securitized and sold off. So you really have that nice alignment between the underwriter making the loans and the investor that's going to have to hold them in the funds and asset value. So that's an alignment that I like, and we do find these useful. The private real estate side, that's actually just not an area we have a ton of expertise in. I will say most of the exposure I see with my clients really is investing with a local developer that they know in the area, or they might own their own second or third properties to have out as rentals. I really kind of like that sort of know what you own strategy with a real estate, but that's not been an area that we've really explored much on the fund side.
I got you. And so when you're looking at those different tranches of alternatives, if you will, one comes across your desk, what's some of the first stuff you do to even see if it's worth taking a further look at?
Yeah, I mean, the first thing is it owning anything real, right? So like when you go with with a trading strategy like a managed futures or one of those, I mean, they all sound really cool and nichey, but they're really just financial instruments. So if you go on the private equity for the private credit space or the real estate side, I mean, you are owning a building, you are owning a piece of financing. I mean, there's a security out there that you can point to and say, okay, I own this. So that's always important to me. You got to look at the leverage ratios. You got to look at the historical performance of that manager. Any hot sector, private credit in particular right now, there's been a lot of shops that just have opened up given where the asset flows are. So you certainly don't want to get into one that just opened 12 months ago and hasn't experienced multiple market cycles. So that's always important. If you're going to be locking up your money and you're going to be turning it over in an LP format, you certainly want to know who their auditor is and make sure it's independent. Who is the custodian? Where are those assets held? Are they separate and distinct from the fund that's managing it? Those are all the kind of the big red flags that we would always have with those. And frankly, at the end of the day, the question that I always ask clients that often will bring these to our attention is, do you want the complexity? Do you want the lockup? Do you have the capacity for the lockup? Has this done better than what you can just get by being in the public markets? I mean, all these sound really cool and exciting, but ultimately, if they're not doing better than what you can just buy and sell daily, then to us it just becomes not worthwhile. And that's unfortunately, in my opinion, I think that's a big problem with the alt space is that a lot of these strategies, frankly, just don't do that well relative to what you can find in public markets. And that's not to say that none of them do, but from what I see, a lot of them don't.
Yeah, yeah, no, for sure. And I noticed you mentioned that for some of those trading strategies, they were really touted for their lack of correlation to the markets, right? Is that the primary thing you look for in an alt? Is that the role you want it to play in a portfolio, or are there other roles that you look for alts to play as well?
I mean, ultimately, I'm looking to get the best return I can get in a portfolio. I mean, again, I don't want low correlation to be coupled with a low potential return because that money that you're going to allocate has got to come from somewhere. So if I'm taking it from the public markets, then I'm making a determination that this dollar can do better or it serves the client better by not being where it was before, and that's always the hurdle that I use. So if it's supposed to be equity like returns, then they better be equity like returns. because otherwise, why did I reduce my equities for it? If it's a yield play, then it needs to be substantially better than what I can get in public markets without just being a massive levered risk play, right? I mean, to get 11% in private credit today, particularly if you're going up the market cap scale with these middle market companies. I mean, yes, these are not rated companies, and you can probably classify them as junk, but you're getting a spread over public high yield bonds that are out there in a wrapper that allows you to own, first lien in most cases secured loans as opposed to unsecured pieces of paper. So that's attractive to me because you're taking some money out of a public market, putting into a private market, getting a spread over that public market without just saying we're going to jack up the risk profile.
Yeah. Yeah. No, that makes a lot of sense. So low correlation, nice, but yield much nicer in your mind.
Yeah, ultimately, got to make money with it. I mean, that's ultimately what it's all about.
Yeah. Yeah, for sure. And then are there any alts that you're interested in learning more about in 2024?
I'd say and again, we're going to be like a lot of folks out there right now. I mean, private credit really is interesting. There's been a lot of press about it lately, which hasn't been flattering. But this is a major market that just is not being dealt with properly by the traditional banking sector. That has some nice opportunities for investors out there. And even in a falling rate environment, should we get that, there's some ability in that private credit space to sort of maintain an edge or that spread over what you're able to get on the public side of fixed income. So that's probably right now the most intriguing thing because again, if I can get equity like returns out of what is essentially a bond type of investment, at least from a volatility perspective, that's attractive to me.
Yeah, no, I love that you say that. And you're talking about private credit lending to businesses. Obviously, Stallion Capital is private real estate debt fund, so
Yeah.
similar.
Yep. Yep. Absolutely.
Stuff under our loans is just real estate. But I'm curious. I had a another RA on who, or maybe it was just a conversation. Maybe it wasn't on the podcast, but they talked about how private credit has been talked about so much that it made them think of the Warren Buffett quote: "When others are greedy, be fearful, and when others are fearful, be greedy." Do you feel like it's
Yep.
gotten enough out there in the public, or it's been published enough or talked about enough to the point where it's like maybe we should start being fearful because too many people are getting greedy? Or do you feel like the opportunity is still abundant?
I think, I mean, you've always got to pay attention to that because when there's that much in flows, you're going to get some bad actors that are going to crop up. I mean, ultimately, you're entrusting the underwriter to make good loans. I mean, that's in essence what you're doing. If you were to own a traditional community bank on the equity side, I mean, you are buying a loan book, right? You're just buying it through the traditional banking channel, which by the way is by design highly levered, right? That's the nature of banking. So you're it's not that there's no risk in banking, but it's a known risk. Everyone's aware of it. Everyone knows there's FDIC insurance if one fails, and but those loans can go bad, and that can destroy equity returns for the folks that own those shares. On the private credit side, again, you got to know that the underwriter is doing their due diligence. You got to know what type of companies they're loaning to. Are they able to maintain their NAV? Are they earning their distribution yield? I mean, those are all the things that you got to be comfortable with before you dive in. And there's going to be some bad actors and some bad press in that space. I mean, this now I think over $1 trillion of capital has flowed into there, where 10 years ago it was a fraction of that. So there's gonna there will be bad actors, no question about it. You just got to do your due diligence and find the ones that are making good loans and have good covenants and so forth.
For sure, for sure. I do want to jump a little bit back to you and West Financial. Talk to
Oh,
us
sure.
a bit more about what you kind of think is ideal to a kind of client advisor relationship. What's the number one thing that needs to be there?
I think clear, actionable communication is probably the most underappreciated aspect of that client advisor relationship. I mean, too often our industry gets into this habit where we're communicating as if we're writing an article for the Wall Street Journal or we're on a podcast, right? Whereas there's this high level explanation and then kind of a vague call to action. So I'll give you an example. Clients often will come to us with an investment idea that the friend told them about, or they read about, or so forth. And this happens quite a lot. And a standard response would be to analyze the investment and send out a few bullet points and say, yeah, this looks good, or no, stay away. A better response is, yes, this looks good, and I think we should invest $25,000 of your portfolio in it because of XYZ reason. What do you think about that? Or no, this doesn't look appealing to me. This other option that's similar but might be a little bit better is more worth your time. Let's put 25,000 of your portfolio in it. What do you think about that? In other words, give the client something to react to, not just a thesis. And another important aspect of the relationship is simply reaching out and being proactive with communication, especially when markets were down. I mean, don't hide behind your desk. In 2022, I would send out emails to clients throughout the year with kind of an explanation of what's going on, but more importantly, what we were or what we are not going to be doing in their portfolios as a response to those market events.
Mm, yeah, I gotcha. And then final question for you. How can people really tell you guys apart from other financial advisors?
Yeah, so West Financial has been in business in the DC metro area since 1982, and we actually started off as a financial planning firm. And if you think of the financial services industry of the 1980s, you probably think of high commission brokers and not financial fiduciaries. And so we really were a pioneer in what became the fee only RIA model. And so today we have $2 billion of assets under management. I lead a relationship team that comprises of myself, a portfolio manager, and a client service associate. And there's 6 of these teams here at West Financial. So the 110 families that I work with all have 3 dedicated professionals that they can talk to, which is helpful when I'm in a meeting or I'm on the phone or on a podcast or what have you. And there's these other 2 team members who can take their phone call, know who the client is, and what their needs are. The other advantage I think we have is financial planning really is in our DNA here because that was the origin of the firm. And so if I have an hour long meeting with a client, 5 to 10 minutes is spent on the investments. The other 50 to 55 minutes that's spent on what's going on in their life. Are they buying a second home, and if so, what's the best way to finance that? Do they have a potential taxable estate should the current exemption expire at the end of 2025? Did they just have grandchildren, and should they start funding 529s? When should they take Social Security? And should they think about Roth conversions between now and when their RMDs start? I mean, those are all the things that really matter, and they move the needle. And they're also the aspects of the job that I just love doing the most. And don't get me wrong, the investment piece is important. I feel we do a great job, particularly in how we focus on using individual securities as much as possible, rather than third-party products to really lower the portfolio fees and to increase the tax efficiency. And having a dedicated portfolio manager allows our clients to communicate directly with the person that's making the trades, and I think that's a huge value add. Like, hey, why did you buy me this, or why did you sell that? There's a person that can substantively answer that question because they were the ones that did it. So, in short, I think we've got a compelling private client offering that combines a really high touch service and a high degree of competence in planning and asset management.
Yeah.
And that's West Financial.
Absolutely. Well, that was I love that. I appreciate it. I specifically like the team model and how you're always there because that
Yep,
clear actionable communication is powerful and it's the most important thing to the client relationship. But if it happens slowly, I imagine that would not make happy clients. So the fact that you guys
that's right.
always have somebody there ready to do the communication is really nice. Well, Matt, if people want to figure out more about you and more about West Financial, where should they go?
Well, they can certainly find us on the web, westfinancial.com. We're on LinkedIn, and you've got contact information there that you can ping me. I've got a bio page there that links back to my email. So certainly see us on the web or on LinkedIn or wherever social media finds you. We're out there. And I should also say, because my compliance department would kill me, that all my commentary here is not. Should not be construed as investment advice, and past performance is never a guarantee of future results.
There we go. There we go.
Always got to end on that one,
Yep, got
right?
the compliance check mark. And if you guys are
That's right.
looking to figure out more about Matt or West Financial, the links will be down in the show notes. Thank you so much for watching, and we'll see you guys on the next one.